I'm Dan Dixon. I hate everything about my retirement planning industry, and we're going to talk today with Al Beam of Dunamis Capital about a problem that we've seen in the industry where people with not enough assets are getting cut out of the information that they're seeking. I've tried a lot of different avenues to find information that I can reliably send to people and piece it together here and there, and it's my industry. If you're out there on your own looking for this information, good luck, because there's barrier to entries in this industry, and 500K seems to be about where it's at. We've covered in some of our earlier videos, we've covered individual topics. I think the purpose of today's chat, and I'll give some insight as to why I think you're the right guy for this. Purpose of today's chat is really to talk about how the everyday investor, and I'll call them the middle class investor, has over the last maybe 25 years been excluded from retirement advice. And I think we've seen that in the clients that we bring in here. Almost everybody that walks into our offices is scared to death. They don't know where to turn for retirement. And largely anywhere that they go, they're met with the first question of, how much money do you have? And if it's not enough, they're shown the door. And I think we can cover, a lot of your background, why you have insight as to why that's happening to people, how they can avoid it. But let's just start with who you are. And I think two things are important that I've heard you say, and I'll let you expand. But you started in the hedge fund world, and so you know what the billion-dollar players are doing. But you also operate a business that you cater to teachers and lawyers and the everyday person now, and you manage those funds. And so now you can see from a retail perspective how hard it is for people to get just basic answers about Social Security or Medicare or their basic investments. Um, so I'll kind of turn it over to you. I think there's a couple of pieces that we could look at, specifically the changes in compensation to advisors. But then also the addition of electronic brokerage houses to the market, making stock trading really not that big of a hurdle.
Definitely. I really enjoy the opportunity of being with you today. Um, my history spans, yes, a start in the hedge fund industry where the owner had built previously three very successful hedge funds, but he also built a retail mutual fund empire, so to speak, which was sold to Wells Fargo in 2002. And I watched the evolution of the industry over that time frame, which has been since 1996. I then transitioned to the retirement business, very large insurance company that ran municipal plans. And then I saw, as I was in that career, a transition to everything going online. Now, the joke of it all, in around 1994, Fidelity became the laughingstock of the industry by telling the retirement players, quote unquote, we don't need the consultant in the field. We can do this online with the client. And they failed so miserably that they became the laughing stock for years. Interestingly enough, in my last career stint in that retirement company, we saw the industry changing literally in front of us. So what we did is that we sat in front of the client, we stood in front of them at the seminar, but more so it was the knee to knee, eye to eye contact, body inflections, the nervousness. Can I really do this? And we reassured them and helped them one on one. That's no longer happening. People are being told to go to a computer screen and they're being given jargon of these are the investment models and this is what you choose. And so by the time now that I've come up in the industry, so to speak, of building my business and meeting with people who spend 15 to 25 years with a quote unquote portfolio that's worth close to $1 million, I find them less educated than the people that I sat with years ago. And I'm like, what in the world is happening? There's a huge disconnect between what the retirement industry is called in education, understanding, and the bridge to knowledge. And they sit in front of you, they sit in front of me, and they're basically babies. And we have to hold their hands at that point and bring them back to the knee to knee, eye to eye interaction. And I think there's nothing more important than the personal advisor situation. And then I think you're going to get into why the industry has abandoned this. But that's what I've been seeing. Yeah.
I think there definitely is a need for the personal advisor. What I have found industry wide is that some of these larger firms, they create these barriers of 500,000 or 1,000,000 is their minimum to entry. And frankly, I mean, the people who need this advice, I think, are teachers and, the everyday worker who doesn't maybe have a 500,000. They worked for 30 years and they've got a quarter of a million, which is a heck of a lot of money, but it's not enough money to justify an advisor sitting down with them one on one in a big firm and planning out their retirement. I mean, the math on that is a $500,000 account, I think, is worth maybe $5,000 to an advisor over the course of a year at the most. And so, if you don't have that level of asset, I've found the industry is really cutting you off. I think you can rewind that back to a date. You can say maybe like 1995, the mid 90s. In my researching, I know I'm not that old. Um, but in everything that I've read, you can look back to like the 1995 time. There was a bunch of legislations that came through. I think the Tully Commission was in that time, and that I think was a big change in how advisors were compensated. And the best I can tell is that when the industry went from a commission-based model, which, don't get me wrong, there's a lot of areas for fraud and overturning, and there's a lot of areas of concern with that model. But when it went from that model to the assets under management model or just fee for management model, it seems like the access to information went away for anybody under those minimum thresholds. And it's really hard for me to find a place to point for people to go now to find that information. I mean, I can't say go talk to a financial planner because they don't want to talk to you unless you have a 500,000. So, can you talk about how you've seen the industry, I would say, devolve for those, lower tiered accounts is what, the industry would call them. I don't want to make them feel on a lower tier because they have less money, but that's what the industry is saying. Can you talk to that at all?
Yeah, definitely. Having worked in that hedge fund and mutual fund environment, I became at one stage of my career a financial wholesaler. So everyone is used to the term of a wholesaler for, let's say, food distribution or supplies of any sort. The wholesaler is between the manufacturer and the supply chain. But there's also a wholesaler in finance. So my role was to meet with the quote unquote portfolio manager, a Harvard trained, a Brown University, Ivy League trained personality, male or female. He or she would talk me through the portfolio. I would board a plane with my laptop, my cell phone, and go to New York and Jersey, try to get the attention of a highly paid broker sitting in his office in any one of the big Wall Street houses. And then suddenly along came this terminology of assets under management, which was very foreign at the time because the financial planner and or broker or the wirehouse all shared the commission structure. And one of the financial houses that was in the middle of this change was American Express Financial Advisors. And the firm that I was with took it upon themselves to help these guys to transition from the commission to the assets under management. And we thought it was the best thing since sliced bread. But from what you said and from what I see, somewhere along the way, nobody mentioned the fact that the economies of scale would not support the middle class client because the advisor has unbelievable expenses to meet. And we certainly don't get into the industry for just getting by.
Mhm.
There are expectations that we need to grow and do well. And it just so happens for you looking at a $5,000 compensation for the entire year for sitting with a client and reading body language and reassuring them. The term not worth your time sounds rather harsh, but it is the harsh reality of the business.
Don't you think, and I think that assets under management has settled at 1% because there's two sides of the coin. There is the stock trader who is not doing financial planning for you. He's just carrying out transactions when you request. But then you also have financial planners who probably need to charge more than 1%, but they have to compete with discount brokerages, online brokerages. And so, unless you're talking about super high ultra net worth people, 1% seems to be the landing spot. But at 1%, you have to have, or at least bigger firms have to set these minimums, which seems to be a barrier to entry into retirement advice.
Here, let's talk about that for a while. And I have to speak because people get very confused with this percentage issue where you step into someone in my industry and they say they're charging 1%, but is it really 1%? In my case, it is because I'm regulated by the state or I can be regulated by the SEC. In my case, it's the state. If you present to the state anything over 1%, the state wants very detailed explanations. Why do you believe you justify that extra expense? I shared management with a specialized trader out of Texas, and the state accepted that, but they constantly kept on asking, Al, could you do better for the client by yourself? In many cases, when people hear 1%, hidden in the fine print, there's 12B1 revenue sharing fees.
In addition,
There is account maintenance fees that are hidden as well. They may not be hidden, but they're not so evident to the client because the financial advisor keeps pointing to the 1%. In my case, it's a no transaction fee arrangement. The only time you pay a commission is if you're buying a foreign security. But the real issue is when you take that 1% and multiply it by assets, you only have two answers to the puzzle. You either have to have a lot of clients volume or the clients have to have a lot of assets. And anytime you're going to spend time with that person underneath that particular scale, you have to measure how much time you're dealing with them. What do? I believe that you can build your business on different levels. So I've diversified my firm to do other capabilities. But no, for someone who comes in and says, I'm just going to charge do a fee-based management business, the time spent with the client is a premium. And guess who loses? The one with the least amount of assets.
So that kind of leads me to the next thing. And you've seen this kind of in our industry over time, is that if, let's say, you don't meet the minimum requirements for one of their personal advisors, some of these bigger firms will give you a robo advisor or throw you into, I'm assuming, a pool where you get an AI generated advisor, so to speak. While I'm sure that that serves a purpose and it is, obviously it's working for some firms, that robo advisor, I feel like is another barrier to people getting personalized advice. And I'll kind of clarify my question to you. I see a lot of advice given and it's carpet blanket advice, but there's no personalized service that goes along with that. There's no smile and handshake that goes along with that. And I think to the generation of people who are retiring right now, that is still really, really important to them. So how do you settle for, as a lower tiered investor, as they want to call you, or whatever their terminology is, if you don't meet their minimums and they slam you with a robo advisor, what would be your best advice on how to seek out that personal service that maybe 15, 20, 25 years ago came with a financial representative that was doing your planning for you, but now you're stuck with a robo advisor because you don't have the level of assets to qualify for a real person?
7 to 9 years ago, the coming or advent of the robo-advisor was considered to be the solution to all of this. And the personal advisor was decried by the so-called smart, technologically adept people in the industry. 2 to 3 years in, it started to fail miserably. It has now been parked in the retirement plans as the option you can choose, but it proves that money management and financial realities does not go well in hand with across the screen, just an across the screen interaction. If there's not a person sitting there listening, being able to adjust and I don't think it's always an issue of management. I think it's an issue of caring. It's a issue of inflection where people know that someone cares about the changes I'm making. Because the robot certainly can factor changes in your family, divorces, a grown adult child who is not so grown and having challenges, having you spend some of your 401k to rescue a family member and you want to know how to adjust. The robot at that point thinks that you are indisciplined and it leaves you behind. And all it tells you is that, well, you lost out 2 to 3 years and you're going to be behind. And you're left hanging out in the cold and no one is there to help you. So the robo advisor has not failed miserably, but it's certainly not the solution.
Do you think that it was their, and when I say they, the bigger investment firms' answer to this problem that we're talking about? If you don't have enough assets, we can't dedicate a real person to you. But here is this AI that we've generated that we think is going to do largely the same thing. Now, they realize that there's this subset of the population that doesn't have assets, but they don't want to throw them away, so they just hand them this robo advisor. Is that kind of what your takeaway is?
It will be very interesting, in my opinion, for AI to get into the mix because AI now has a lot more information to parse. What do they call it again? Generative AI will respond to your issues. So I am very interested to see if that will be a help. And I believe it may. I want it to be. I don't want to sit here and think that I should be slamming solutions that are necessarily automated and it doesn't involve me. In my case, I even have to choose some interactions. Now, hold on, because of my business being built with less overhead or as least as possible, I can take that smaller interaction and make it profitable over time, as I suppose you do as well. But one has to wonder, what about the person who is just afraid to come sit in front of us because maybe they're intimidated?
Mm-hmm.
Maybe they think that we are seeming to be nice, but we're distant and we're just polished. And there are a lot of different reactions in the industry for the person who has never sat with people like ourselves. And frankly, they're probably listening to interactions that their family members or friends had with an advisor who wanted to be nice, but kept glancing at his watch or looking up at the clock at the wall. And with short and curt answers, they know that they're not worth the advisor's time.
Right.
So I believe that an automated solution, along with AI, along with the junior advisor, I hope it will be a solution that works for the industry. But still, I believe that my business model and yours, because we're familiar with each other, are able to make it work at a level where the rest of the industry is just failing and failing miserably, so to speak.
And I can speak for my business, and I think you'll probably agree that we've seen a huge influx of people who have run up against this problem of not being able to, have an advisor because maybe they've worked 40 years and they've saved their money, but they don't have the level of assets to qualify for a personal advisor. We've seen a tremendous shift of people just taking this on investing, I mean, on their own. Uh, Managing their own portfolios and trying to become their own expert. What I think there's two pieces of this question. A, I think there's a giant portion of our population that spent 40 years working not with the intention of becoming investment professionals. Two, it's we've seen a pretty tremendous market run over the last 10 years, and I fear that that has instilled some fake confidence in some of these investors who have jumped into the market, maybe done some researching, but don't have years of experience, or the want to create their own retirement plan, but feel like maybe there's no option. Talk about um, kind of some of the dangers of that, and how you've seen that shift to people just managing their own accounts because they can't find somebody that they qualified to meet with.
So I'll be entirely frank. I came up in a mutual fund slash hedge fund industry subset, which makes me rather unique. I'm not looking for a solution that's packaged, I'm building it. But hold on. Yes, you're correct. There was the meme investing, and people felt that the Robin Hoods of the world were going to make them the best thing ever. The sad reality, it's just simply younger players in the industry that were very upset with the more seasoned elite gray-haired temple guys in the industry, and so they created this whatever Wall Street movement and rebelled and went out on their own. The industry doesn't work like that. These gray-haired temple elites pretty much allowed them to believe that they could do things by themselves, and this is what hurts me. The guys who run the Robin Hoods of the world and the various trading platforms did not tell their followers that they had to go back and play obeisance to the elites of the industry. They had to go back and say, guys, we're sorry. We cannot afford the trades. We don't have the volumes. So the Robin Hoods of the world started to report right back to the guys they said they rebelled at. And the only reason people are still saying that they don't need an advisor and they're doing well is because of what you just said. It's what we call in industry. It sounds rude, but it's a good market where you can put a chimp on a stool, blindfold him, and he can hit the dartboard 2 or 3 times. When this market turns on its heel and sits out for 16 months at a turn, fortunes are going to be devastated. And it scares me to think that people think that they're efficient, but they really don't know what they're doing. They have not managed money through, like I have, 3 major US recessions and see how it can devastate someone. But let's talk about where the real money is at. The real money, in my opinion, is with that middle class player who spends 25 to 40 years in a career, uses mutual funds, which in my opinion is a solution, but not the best. They're getting old and long in the tooth, and that person has built up quite a bit of assets. If the market turns on its heel, the mutual fund needs about 2.5 to 3 years to recover. Does the person have that time to recover? Possibly not. So you have the younger investor believing, the millennial believing that they're smarter, they don't need the advisor. You have the older investor who depended upon the mutual funds, but has never really seen a bear market with its fanged beard. And I see both issues creating almost a perfect storm if this market turns on us. And it has not been doing that, but I anticipate that it's sometime.
Sure. And, nobody has a crystal ball, but I find it very hard to find reliable information. I assume these, you know, everyday investors who have turned that into their job are finding it, hard to find that information as well. Um, I want to circle back to the robo advisor and just that thought for a minute and
Mhm.
ask you, you know, there are a lot of people that we interact with that don't need very high level retirement planning, but they do need some retirement advice. Don't you think that the robo advisor and that mutual fund style of set it and forget it investment has led itself to people not knowing where to turn for those kind of more simple answers, like, hey, when should I take my Social Security? Or how should I take Medicare? Or how should I access some of these other retirement questions? Don't you think the robo advisor has kind of taken that off the plate for some people? And if so, besides just us and this channel, how can they access information reliably?
I think the real issue lies in the fact that no one class of assets is superior to the other. They should all be working in their own subset, but complementing or working in concert with each other. And that's the biggest problem, in my opinion, with the industry. I've worked with hedge funds, mutual fund firms, large insurance companies. And let me be blunt, they absolutely hate each other. Each one is saying, I'm the best thing ever. And they discount or decry the benefits or advantages to the subset of what that asset class would bring to the client. And I watched in despair as, let's say, my last career stint. I'm managing approximately $500 million for 30 cities and counties. I go to my director, we go to the actuary of the insurance company that's managing the assets, and we say, why don't we offer the client a solution such as an annuity? Hold on. The annuity was available, and this is I won't call names here, but this was a powerful insurance company worth $370 billion. But in that market space, they said the client should only have variable annuity mutual funds, and they would not give the client the assurance of their annuity that they gave to another client in another asset group, in quote unquote. So the client missed out on risk mitigation, because that's what an annuity does. Takes your assets and it multiplies it over a particular time frame, albeit it has some restrictions. And then you complement it with investment management. So I said to them, we could be the perfect solution. And they said to me, Al, no, they don't qualify for our next level. So my issue in this with the industry at the time, and why I chose to be a hybrid solution, meeting you, working with you, is that we operate from a silo existence in the industry, and we are hurting the client like crazy, but we don't care. Why? We are knowledgeable, we are well paid, and for the most part, we lead disciplined lifestyles, and we're rather secure ourselves. But we are disadvantaging the client from having these silos become a bridge. And I think that should be the next discussion. Why would the client not benefit from different asset classes?
So, we've kind of covered what these barriers to entry are, what it looks like for these people. Um, I I would say in my time in the industry, and I'll say a little over 15 years, I've seen that barrier double. I would say minimums on accounts when I first remember looking into this as a thing, I would say we're about 250,000. Today, most firms, if you go across, you look at any of the big investment firms, and we don't need to list names, but they say 500K, and it's almost to the company. Every single one of them says 500K to get access to an advisor. Do you see that increasing at all going forward? Because look, if $5,000 a year isn't enough for somebody now as an advisor to create a financial plan for me, what is that maximum? Do you think that that's going to continue to move in that higher net worth direction, or is there some world where that moves in the other direction? I haven't seen that, but I'll kind of ask your insight.
The likelihood it's gonna go north and leave the regular investor south. If they can figure out how to integrate generative AI, which is adapting to the client, answering questions, they may be able to come up with a solution where we don't have to meet with the client for every interaction, and they can interact with the AI, personalized to the firm's values and whatever they want the client to hear, and overall education. But the likelihood is that like we see neighborhoods change, and the industry is going to continue to gentrify and go up in assets. The good thing for you and I is that we have found how to help that smaller client, um, to be able to spend time with them and make them worthwhile. And then they, in return, are so grateful they make referrals to us. And what we would have earned or need 3 people to earn, they're giving us 6 referrals. And we find that, and that comes from another place with me because apart from being a professional, I'm a spiritual person. I named the firm with a spiritual aspect, reminding people that I'm giving them the capacity to build wealth, but with meaning. So that gives me a warm, fuzzy place, but it tells me that I've not been able to attract any young advisors to learn from me who's not interested in telling me how much they want to make within 2 years, when it took me 20 odd years to get to where I am. So what does that tell you and I? It tells us that when we exit, unless we find a solution that's viable, the industry that is, people are going to be left out in the cold.
So, I would say then you're saying advisors that are looking to get into the business look at it as a money grab. I think that it would make sense then that clients are looking at people in our profession as everybody is just out to grab as much money of mine as possible and make as much on that money as possible, which I think we've seen the industry shift to. Um, I guess my question is, these big, we see people all the time and they talk about my guy, right? My investment guy. And largely those guys work at the big firms. And we, again, don't need to name names. But I think the disconnect for a lot of people comes from how those advisors are compensated, right? The big firms, they are charging 1% as an advisory fee, but that advisor doesn't get to keep all that money, right? The big corporation keeps the majority of those fees that are turned in. And so I think that is really when we talk about this, when it boils down to it, if you have a financial advisor and he's charging you 1% and you go in and you try to sit down and you try to ask, when should I take my Social Security? Or what should I do for my Medicare? Or you ask a question that isn't directly going to benefit that advisor's pocket, and maybe I'm picking a fight here. Um, do you feel like there even is a place in financial planning for those ancillary retirement questions, or is that just a different person altogether that they should be asking?
It's very unfortunate. I mentioned about my financial wholesaling history and experience. And during that stint of the industry time, I spent wholesaling 25 to 30 major brokerage firms and wirehouses. So if they're listening to this video or broadcast, they should be very afraid of me. I know their business models. I sat with them and helped them close sales. They may have evolved a bit, but not really, because I look at their client statements. Here's
Let's
what,
circle back to that point.
yeah, here's what's bothering me. For the guy who comes in front of me and says, my guy, and then I look at their statement, they're paying a financial planner slash broker trader to make them, like I saw the other day, 3%, 5%, the most made 14% over the last 7 years. So when I go through the portfolio, I'm seeing treasury buys. People don't buy treasuries that get paid fees for clients. I saw mutual funds that as soon as the market turned on its heel, they dropped 30 to 50%. I saw buys in companies that were obviously told to them to be bought by the branch manager because the firm needed to trade that security for something else they're doing, whether it be a bank investment deal. So it tells me that,
Quotas.
yeah, so that tells me then that my guy is not really your guy.
Mhm.
And it's kind of, sometimes I say to myself, do I want to break the sad realities of this person or leave them in the nirvana that they need to be? So where you meet with someone being a specialist in Social Security, where I meet someone and speak to them about investments, stock selection, and building instruments of bonds and creating returns that are level and stable and can meet recessionary periods. We are we are at a wealth manager status, but we're not charging for it, nor can we, because the people that we're dealing with can't afford it. But would you believe it that it's available in the industry? There's that wealth manager who will even pay your bills, and you can travel all year and never, you could be on a sailboat in the Pacific, and the wealth manager and their concierge service will pay your bills, manage your rentals, deal with your social security. Everything that there needs to be is taken care of by the wealth manager. But you can't touch him unless you have $2 to $3 million. So anyone watching this video need to say to themselves, hold on, you have two guys who bring all of these capabilities, maybe in a hodgepodge manner, but we're offering what the $2 to $3 million client is getting from their quote unquote wealth manager. That when you sit with him, the attorney sitting there, the tax person, and him, and we're able to bring all these professionals together, maybe not in such a fluid and professional environment, but we can coordinate it. You should be calling us.
Agreed. And don't you think that that has built kind of this world where if you don't have 250,000 or $500,000 that you feel like you don't have access to those kind of advisors, which maybe you don't feel like that because you don't have access to them. Because and maybe somebody like you is able to take a little bit more time with those lower net worth clients because you don't have the overhead of the big corporation over your umbrella. You are Al Beam. You don't have to pay part of that 1% that you're charging in management fee to XYZ Corporation. You get to keep your 1%. You don't have to siphon off a small part. I'll just give you an example. I have a very good friend who is an advisor with one of the biggest brokerage firms that there is. Now he's a wealth manager. His minimum is 500K, but he charges 1%. His fee is 1%, but he doesn't get to keep all of that. A large portion of that is siphoned off to the brokerage house that he works for. I think that that is in itself a barrier to him being able to provide advice. He is getting compensated even less than that 1%, significantly less than that 1%, and expected to provide the same level of advice and care that you do, being able to keep the 1%. I think there is an element to that that is going to say he has to see more people and put more people through his pipeline, but also have a minimum of 500,000 that keeps people from getting his advice. Do you see that as a problem for people?
Very much so. And the reality of the industry, let's just be clear. You're going to have to pay for the office space. You're going to have to pay various levels of insurance, errors and omission. You're going to have an attorney on tap, a securities attorney. You're going to have a compliance consultant on tap. Yeah, so all these expenses are tremendous. So what is the advisor in the big firm working at? Most of those expenses are absorbed by the parent company, and if they expand the book, they can sell the book. That's what it's all about.
Makes sense. My problem and the thing that I see here is that when we're meeting with people and we're talking about their retirement, we're talking about more than just how their assets are invested and what the yield is going to be. There are so many decisions that go into retirement. It takes a lot of time to sit down with a single or a couple that is nearing retirement and put together a plan for them from beginning to end. I think those low compensation models for those advisors in the bigger firms are they can't dedicate that amount of time to sit and say, Mr. and Mrs. Client, you get to make this choice once. You get to elect Social Security once. You get to elect your Medicare. You have one free guaranteed issue period. You get one chance to roll over your 401k. All of those things require a lot of time. And if I'm cutting back how much compensation the person who is actually running those meetings gets to control, I think that that is the answer probably that we're looking for that says, listen, this guy's just not getting paid enough to do all of these things with you. And that's really a barrier to getting real retirement advice.
Yes, I believe that meeting with a client for the first time and getting to know them takes me on average a 2 to 2.5 hour meeting because I have to bring them into a partnership and an understanding of where they're going. And then I may have to integrate other professionals like a real estate attorney or a CPA to help them with their books or something of the sort. Um, my sister-in-law works for a huge insurance company that dabbles quite a bit into the investment world. In fact, it's one of the most successful and powerful businesses. And she was amazed when she heard about my business model because, in her regard, there's a team to do everything that I do. And the client is given this unbelievable set of brochures, beautiful, glossy brochures. But can I share a surprise with you? The state of Florida says when they assign the firm the registered investment advisory designation or license, they say you're supposed to tell the client, in my opinion, breaking it down, the good, the bad, and the ugly. And if you see the client running off the edge of the road, you have to jump out in front of them and wave your hands and push them back on. They say that if the client is running off the edge of the road, the client really didn't understand your glossy and beautiful brochures.
It was just pretty pictures.
It was just pretty pictures. So how many people are walking into these professional meetings, stepping out with these impressive brochures, but they really don't understand them, but they don't want to insult their intelligence by saying to the advisor, I really don't understand these graphs. So I tend to spend less time with those graphs and more time with explanation and real world examples. And that's rare. Usually, when you spend that much time with a person, you will know that they learned because the referral that they make, you have to spend less time with that referral. Why? Because they understand so much. I was amazed. Yesterday, I had a meeting and one gentleman brought his friend and he was making half of my presentation because he understood what I stand for. But that's where you have a personal touch that can't be replicated easily.
And I'm going to go a little bit off of kind of the path that we had planned here and just ask, those advisors have to carry such a volume of clients. It feels like to me, just looking at people's portfolios as they bring them into my office and looking at them, that those pretty glossy brochures give the indication that there's going to be some very advanced investing. But what I see when people bring their portfolios in is just a pretty basic split of stocks and bonds that keep them from losing money, and they're not really gaining as much maybe as they possibly could, uh, because the advisor doesn't want to take the time to explain to them how their investments should really work. And so they throw them into this portfolio of a portion of stocks and a portion of bonds that will largely serve the purpose. They're not going to run out of money. They're not going to see huge fluctuations. And they're, I think, maybe trying to just get people from calling their phones with questions with those types of portfolios. But overwhelmingly, those are the portfolios that people are bringing in here. So, how are we justifying that 1% if they're not getting specialized retirement advice, if they are coming to me to answer their Social Security questions, if they have basic stocks and bonds in their portfolio? How can they justify that 1% expense if they're not getting any of those ancillary benefits that we've already talked about?
It's not really justified, but that advisor or financial planner is not regulated by the state or SEC. And I have to speak from my world. The state showed up in my office last year after a stint of COVID delaying them for a year. They're supposed to do 2-year examinations, and they spent from January till September going through the books, every trade, every interaction, every correspondence with the client. And trust me, they ask the questions 3 different ways. That doesn't happen in the big brokerage houses.
It doesn't. They don't
No,
have time.
no. The chief compliance officer, CCO, who is probably a former employee of the SEC, meets them, interacts with them, and answers on behalf of the broker or financial planner. And how many times have you and I woken up in the morning and heard that these huge brokerage firms are paying out 25 million, $30 million
100 billion.
in fines, but in the larger scheme of the economies of scale, it's just a liability and they pay it and they move on. So sometimes people come and they look at us and I see sometimes the attitude. How could you be as good as the other firm? What they don't know is that they're being lost between the cracks in the other firm.
That's right. And you don't know what you don't know. You don't know what questions to ask.
Exactly.
If you go from brokerage firm to brokerage firm to brokerage firm, you're largely going to get the same treatment. You're just going to get different faces. They all operate the same, at least in my experience. That brings me to a follow-up. And I'm going to keep hitting on these individual pieces because it's some of the areas that I see people failing in retirement planning. And I think all of what we've talked about leads into this. You and I analyze people's portfolios and their retirement plans on a daily basis and have done so for a long time. I didn't give you any prep on this question, so I'll be interested to see what your response is. How many people that come in that have either met with their financial advisor or tell you that they have a plan in place have put a plan in place for their long-term nursing care that Medicare isn't going to pay for at the end of their life? It is a number one cause of bankruptcy among seniors with less than $1 million in assets. How many people that you see have a plan in place for that they've already had from their advisor?
In truth, I haven't seen it. Here's why.
Ever.
The client who would get that treatment would be managed by a wealth manager. And again, they have to have at least $2 to $3 million to have a wealth manager. Hold on, 2 to 3 million in play, and the SEC doesn't allow them to have that much in play unless they're living on at least a cash flow of $1 million. So they would not have the questions for Medicare. Does that make sense?
Absolutely.
They would not have it. So the other person who comes into the office and they think they're okay, there's just gaps that you could drive a tractor trailer through. We don't insult them, but we slowly educate them so they understand that you are leaving yourself open to huge liabilities. And what hurts me at times, I know you don't do life insurance. It's just not a focus for you.
I source it out.
You source it out. I do it, and it's not a focus for me, but I find just huge disparities in the industry where life insurance agents sell life insurance to be the best thing that there is, and it's not real. A life insurance agent, and I'm not afraid of saying this, if they dedicate their time for 7 to 10 years on selling life insurance before they swing their legs off the bed, have a residual income of over $300,000 a year. So that person is not going to allow for you visiting the financial advisor. And that's why I find you so honorable. Because when we are paid by the life insurance industry, they compensate us well without affecting the client. But why are you pulling the wool over the client's eyes and leaving other asset classes that they could be benefiting from? And you talked about the benefits that may be incidental that could crash their entire plan.
Definitely.
And I've met people who told me that my life insurance agent is my financial planner. I'm sorry, it is not true.
Absolutely. There's a lot more to it than just that one piece, but I think that gets lost in the shuffle of trying to go into an investment firm, talk about your investments, talk about your pension, talk about this. And we're talking about something that's 20 to 25 years down the road in retirement, but my gosh, what a big speed bump that goes left. It goes left unturned.
Yes.
And that kind of snaps us into just, there are these little pieces that are out there: Medicare, prescription insurance, Social Security, retirement in general, nursing care, pensions. There's all these other ancillary things that come along with retirement that are not just investing, stocks, bonds, mutual funds. And so I think what has really been very hard for people to piece together is, how do I get all of this information in one piece? I think that this video will be, I don't want to say revolutionary, but generally when you see these videos, it's either people from my side of the fence in the insurance industry or people from your side of the fence in the investment industry. It's very rare that you get people like us together that are on the same page and that we can marry those concepts and put together a real retirement plan for people that encompasses all of that. I feel like that gets lost in a lot of the bigger houses.
I think so. I think so. And it's important to make sure that your financial professional is has tenure, they have experience, they have education, they have a financial designation that goes over these modules. But again, the problem is that we fight cold wars in this industry like never before. The life insurance agent hates the financial planner. The financial planner hates the insurance producer that does retirement. The Medicare person is snubbed. These efficiencies should be brought together for the client, but again, it's not. I suggest someone who doesn't understand this take a very close listen and parse the information that we have shared and see the huge gaps of what they're missing out on. And it's not that they don't exist, but they don't exist unless you're a wealth management client.
So, and I want to just do a point of clarification here. There's a lot of abbreviations and acronyms that go along with investment professionals' names, and I know that you have some of them associated with yours. Your RIA designation is very different than that, and I think that it's important to detail for people. Some of those designations you pay for, and it's just your name on a list. And some you actually have to register yourself and be monitored by, a governing agency, in your case, the state of Florida that you're doing business in. Is that somewhere where people can reliably go? Somewhere, somebody like you who is an RIA, is that somewhere that somebody who, say, doesn't meet the $500,000 minimum criteria, is that a direction that people can go to? And should they favor an RIA versus some other designations? What are the differences, and do you see that as a benefit to people?
It can be, and it can also be the Cold War continued. I see one of the largest and most successful RIA on Google paying millions of dollars to Google to misinform the public at large about the other parts of the industry.
Mm-hmm.
And all you need to do is go to the first pages of Google and just say, what is wrong with an annuity? And you'll find out who I'm talking about. Won't call his name.
Find.
Won't call his name. But yet still, he's a RIA who the SEC expects to educate the client about everything. But he is so wealthy and so powerful that he pays Google to misinform the public about any asset that he doesn't manage. So it doesn't necessarily mean that because a person is a RIA, it means that you're going to get efficient information from them. I think that you should do some research yourself. I think that you should trust your guts. You should check out the person. You should read their reviews. And usually we leave like a cockroach walks through flour, like my grandfather used to say, and leaves a trail. People in my industry usually leave either reviews behind them that are notable, or they leave complaints and a carnage behind them. I'm proud to say that I don't have that in my history. People need to trust their guts when it comes to dealing with people like myself in this industry.
Agreed. Tell me about your soldier and your wall framework.
I was taught in the hedge fund industry what is called a core strategy. And I still mean to take it to the level where I'm sitting there with my iPad and I'm drawing and it shows up on my huge screens in the office. But usually I just take a pad and I draw 3 concentric circles. The middle circle is supposed to be your core. In that circle is your pension. In that circle is residential property that you don't owe a mortgage on. It's the mall or commercial property. It's a life insurance trust. It's stuff that cannot be affected by the economy and the markets. That's your core. In that place, life insurance companies rule supreme because they provide a hard asset that cannot be breached by bankruptcy or lawsuits, which is an annuity. And that's why approximately 75 billion on average per quarter flows to the life insurance industry. despite what the guy who pays Google says badly about the industry. It must mean they're doing something good. The next circle is where I am. That's investment management. Usually people say they do it themselves and they probably can do it well, but it takes up a lot of your time. But that's what you pay a financial advisor to do. You pay them to manage your equities and your income vehicles and your cash. The last circle on the edge is where you're doing your own thing. Maybe you're playing Bitcoin and crypto that the advisor doesn't want to get involved in. That's where you're flipping properties, rental properties.
Your riskiest outer fringe.
That's correct. That's where you're paying penny stocks that the advisor says you better be careful, but we don't make it a problem for ourselves. That's where you can start a business and fail or sell it off. That's the outer circle. So the analogy is a soldier, like we were in Afghanistan for 20 odd years. Soldiers will go into the middle of the desert and build a base, a forward operating base. The middle circle is their most defensible and strongest position. That's where the APC, the armored personnel carriers, are. And then they will fire on the enemy from the second or the last fringe circle. The analogy is that in a good market, you're confident to take opportunities out from the middle. But when the market acts up, if you don't know, you need to have someone to tell you how to retreat back through those walls so your fortune and your children's fortune is not destroyed. And that's where you need a professional.
I think what is unique, not just about what I do, because I know that inside and out, but specifically about what you do as well, is that there isn't a one size fits all for a client. It's my biggest gripe about the industry. I can go through and look at videos of people giving Social Security advice. And frankly, I looked at one last night and the advice was, everybody should take it at 62 because the break-even point for me is 81. And just in that little piece, the guy's making a huge mistake. He's saying everybody should do this one thing because when he ran his numbers, that's how it worked out for him. Huge mistake. You need to be able to customize that for each person. It's what I appreciate so much about what you do. And what I do is that we have the ability, because our compensation works different. Each customer gets a customizable plan specifically for their retirement. It is not just throwing them into the pot and hoping that their retirement works out. We are customizing it, starting with their Social Security, going through their Medicare, looking at every single detail, and then getting to their investments and how those work into their retirement. So what we aim to avoid is just blanket strategies that we are throwing here. You take this and this is your retirement. And we give that same strategy to everybody. I think that is completely opposite of what we aim to do. Talk to me a little bit about how you are able to customize your plans for each individual person and not everybody's just thrown into a folder.
Sure. I will say this to you. You should run as fast as possible in the opposite direction if you step in front of a professional and they believe or they say to you that they have the complete strategy. There's no such thing. As my granddad used to say, the jack of all trades and master of none.
Yes.
What I think is both our strengths is that we're willing to share solutions with those who specialize in each particular discipline.
That's right.
The advisor who wants to dismiss the other professional just simply because I can't make $1 off the interaction is doing the client a disservice. I say to that advisor, what if you just did the honorable thing? That person is going to refer 10 other persons because they did get the complete solution. But it does involve ourselves, the insurance producer, the annuity specialist, the financial advisor. It involves the real estate attorney. It involves the CPA. It involves the person who specializes in Medicare advice. It could be whomever, but they have to coordinate and they have to commit to working with the planner who is in the center of it all. That, I believe, is what is the complete solution.
Being an expert in retirement, all things retirement.
That's correct.
We've put this video together in hopes that we've taught you how to avoid blanket advice. If you have specialized questions, personalized questions, and you want to reach out, feel free to get in touch with us and we'll be able to handle those on a one-on-one basis.